If you're buying a house, putting 20% down could be an expensive mistake, not because 20% is bad, but because for many buyers it's the wrong number. Today we're going to run the math for three different buyers, and we'll see why one puts down 10%, why one should put down 20, and why the third chose significantly more. And at the end, you'll be able to download the same spreadsheet we're using for free so you can find your own number. Before we meet our three buyers, let's get clear on what's actually in play here. Because when you choose a down payment, you're actually adjusting three financial levers, and most people really only know about one. It's the obvious one. It's how much you actually put down. Put down more, you borrow less, and your monthly payment shrinks. It's nice and simple. The second lever is PMI, a spooky acronym for private mortgage insurance. 20% just happens to be the accepted risk threshold. Go below that, and most lenders will want something in exchange, most likely a monthly PMI fee. PMI is a bit of a boogeyman for new homebuyers, but we'll see if it earns its reputation. The third lever is one that almost no one talks about. It's not something I even considered until I was closing on my third house, and it's called points. You can buy these points from your lender to permanently lower your interest rate. Now, each of our three buyers is going to use these three levers differently depending on their situation. To compare evenly across them, we'll look at how much each of them saved or spent over the conventional 20% down, and we'll see what else, quantitative or qualitative, they gained or lost as a result of their chosen strategy. And there's one force out there that can shift your optimal down payment strategy more than anything else. But we'll circle back to that at the end. Which brings us now to our first buyer, Sue. Sue's relocating for work, and she'd love to buy instead of renting another apartment. The problem? She's only got $50,000 in cash available, but she's looking at a $500,000 home. $50,000 is exactly 10% down, not the full 20. And because Sue's a high earner, she doesn't qualify for any of the down payment assistance programs that might have helped close that gap. In her shoes, most buyers assume they have to get to that 20%, which would leave Sue with only two options. She could keep renting while she saves for another year or two, or she could dip into her 401k and pay a 10% early withdrawal penalty. But Sue has a third option no one told her about. She can simply put 10% down, accept the PMI, and buy the house now. So let's run Sue's numbers, starting with the path she thinks she's supposed to take, the full 20% down. To get there today, she would need to pull the $50,000 out of her 401k. That's a 10% early withdrawal penalty, that's 5% gone, plus the admin headache, plus she's eating into her retirement savings early. It's a pretty hefty additional cost, especially when you consider that Sue's young, so she has a long runway and an aggressive investment portfolio. As a result, she expects cash in that portfolio to grow at 10% on average. Now, her other option is 10% down. Here, Sue keeps her 401k untouched, puts her other $50,000 down, and borrows $450,000. A bigger loan, higher monthly payments, and she picks up PMI since she's under that 20% threshold. Luckily, Sue has excellent credit, so her PMI is on the cheap end, right at about 0.5%. So far, this looks exactly like the trap everyone warns you about. But here's the thing about PMI. It's not forever. It comes off automatically once she's paid down 78% of the home's value, and she can request to remove it earlier at 80%. The workbook tells us exactly when that happens for Sue, which is in year 10. Her total PMI cost up to that point is just over $20,000 total. And because she borrowed $50,000 more, she pays around $65,000 extra in interest over the 30 years of the loan. So PMI is far from free, but it's not really the boogeyman either. It's a temporary fee that ends a third of the way through the loan. The 10% path costs Sue that PMI plus extra interest. The 20% down costs her a $5,000 fee, and then every dollar of growth that the $50,000 would have earned compounding in her retirement account. And that's the bottom line for her. Keeping her money invested in her high expected return is well worth the PMI cost. Sue's choice wasn't about chasing the lowest possible short-term cost. It was her refusing to compromise her future retirement to chase that 20% number. With Sue settled into her new place, let's focus on buyer number 2, Marcus. Marcus is owned before, so he's also not eligible for the first-time homebuyer programs. But unlike Sue, he's not stretching his budget. Marcus is cash for the full 20% down on a $500,000 home without dipping into his emergency fund or his retirement. The question isn't if he can, but if he should put 20% down. So Marcus did what Sue did. He ran his options. First, he tries going lower, like Sue, 10% down so he can keep more cash invested. But this time there are two key differences. Marcus is older and he has a conservative portfolio. In fact, he expects his investments to return only slightly more than the 6.6% mortgage. Second, his credit score is not amazing, so PMI is more expensive for him. Because of these differences, going lower doesn't pay off for Marcus. In fact, it doesn't just lose, it loses badly to 20% down. Going with 10 instead of 20 would cost Marcus around $180,000 over 30 years. Then he tries going higher, more than 20% down. But every extra dollar that he puts into his down payment just earns him that 6.6% mortgage rate. He'd rather have that money invested, even if he's only expecting a slightly higher return. So for Marcus, 20% is his sweet spot, and going lower than that would cost him far more than going higher. He even prices out points, but they don't help either. So for Marcus, the conventional route is the right one, 20% down. Not because it's the default or it's easy, but because he did the math and nothing beat it. So 20% isn't always a trap. There are plenty of people who probably should put 20% down, particularly folks who meet these four criteria. Number one, you can comfortably afford 20% down without draining your emergency fund or raiding your retirement. Number two, you don't qualify for or have ruled out assistance programs. Number three, buying points doesn't beat paying down the loan. Number four, your mortgage rate beats what you'd expect to earn investing the difference, even after the PMI you'd avoid by putting less down. But look again at that last one, your rate versus your expected return. Those market factors are well beyond our control, and if they change, 20% may no longer be Marcus's best option, but we'll come back to that later. Which brings us to our last buyer, Jasmine. Jasmine isn't buying a home to live in, she's buying a rental property, and she spotted a neighborhood she's convinced is about to take off. Her whole bet is appreciation, and to cash in, she has to be prepared to hold the property for years, maybe even decades. She's very bullish on this particular neighborhood, but for her stock market investments, she's expecting around a 9% return on average. Here's her problem. A rental that bleeds cash every month is one she might be forced to sell at the worst possible time. It could be during a downturn or during a personal cash flow crunch. So her goal isn't the lowest 30-year cost like Sue or Marcus, it's the lowest monthly cost. She's looking to get her monthly payments down low enough so that the rent more than pays for everything going forward. For our first two buyers, right meant cheapest over time. For an investor like Jasmine, her goal is shifting. She wants to keep the monthly costs low so that she isn't forced to sell. She's got enough cash for 20% down, plus an extra $75,000 to work with. And she points all of that at one goal, shrinking that monthly payment. First, points. Every dollar toward points reduces her monthly payment more than putting that same dollar toward principal. So she buys the max, 3 points costing around $10,000, which drops her rate from 6.6% all the way to 5.85% for the life of the loan. And she puts everything left over toward a bigger down payment. Both of those moves pull in the same direction. A smaller loan, a lower monthly rate, lower monthly payment. In total, her payment drops by around $600 a month versus the plain 20% down, and the property moves from bleeding cash each month to hopefully breaking even. So how much does that cost her in the long run, including the opportunity cost? Over 30 years, it runs her about $11,000 more than the plain 20% down. But here's what that number misses. If Jasmine had put 20% down and let the property bleed cash each month, the likely outcome isn't that she pays a little more, it's that she won't hold on to the investment. One rough year, and she feels forced to sell early, walking away from the exact appreciation she bought the place for. That's not a few $1,000s we're talking about. That's her whole investment strategy, gone, maybe even sold at a loss. So her extra cost here isn't really wasted. It's more like insurance, a known premium to help her avoid a larger loss. That's Jasmine's right number. It's not the cheapest option, but it's the one that makes her feel comfortable with keeping this asset long term. Before we get to the biggest factor of all in this, interest rates, there's one more lever worth digging into a bit. First-time homebuyer programs. Depending on where you live, these can provide down payment assistance, below market rates, or both. And they're massively underutilized by new buyers. Sue earned too much to qualify, Marcus wasn't a first-time buyer, Jasmine was an investor. But if you're buying your first home, please check the links in the description below to find out more about these programs before you run your own numbers. Now let's circle back to Marcus. Remember that last box on his checklist, the rate versus expected return? As we said, that's subject to change, and it could completely alter Marcus's approach to home buying. Everything we just did assumed today's rate, around 6.6%. But that's just today's number, and rates move a lot more than people realize. Just 5 years ago, you could have locked in a mortgage near 3%. Back in 1981, the average was over 18%. Historically, we're sitting somewhere in the middle of an enormous range, and that's certain to change in the future. So let's drop Marcus into a different economy. Same house, same Marcus, just a different rate. Let's say rates fall back to the 2021 lows, just under 3%. Now his mortgage is cheap enough that the math tips modestly toward going lower. At this 2.65% rate, keeping more cash invested edges out the 20% path. Marcus comes out ahead by about $16,000. It's a slim win, but it's a real flip. Cautious Marcus picks up PMI and becomes a Sue. Now let's flip it. Let's say rates climb between 9 or 10%. Paying down that loan at 9.5 is now a guaranteed 9.5% return. That's better than what he's expecting from the market. The math pushes him past 20%, and at that rate, going with 20 instead of 10 is worth a staggering $300,000 over 30 years. So Marcus now becomes like Jasmine, and he wants to put 20% or more down. Think about what just happened. Marcus didn't change, the house didn't change, his goals didn't change. The only thing that did was the interest rate. Yet the mathematically correct answer swung from 10% down to 20 to more than 20. This is the force that changes the most, and it's not something you can predict. Your right number isn't a number that you find once, it moves when the market moves. So let's bring this all home. We had the same $500,000 house, but 3 buyers and 3 completely different right numbers. Sue put less than 20% down, but she kept her retirement intact and came out ahead of the standard down payment. Marcus ran every option but landed back on 20% down. Not because it's the rule, but because he checked his math and that was right for him. And Jasmine went bigger, buying down her monthly costs so she could hold the investment long term. It was the same house, but they all used a different down payment strategy. Because the right number is about finding the down payment that fits you and your goals in your situation and today's rate. Change any of those and your answer may change. The free workbook below will calculate PMI, points, monthly payments, opportunity cost, and the long-term cost for you automatically. So you can run your own numbers before signing a 30-year commitment, because the difference between the default answer and the right answer can easily be tens of thousands of dollars. So find your right number before you sign. I'm Kev. Thanks for watching. I'll see you next time.